Okay, John Butcofski. How are you, John? I'm going to make you the presenter now. I want to thank you in advance for taking the time to be with us today. Should be hearing your voice and seeing your screen shortly. Captain. Calling Captain John.
Dale.
Dale?
There he is. Hi, John.
You there, buddy? Hey,
I can hear you, bro. Good morning, my trading warrior. Good morning, my trading warrior brother. How are you today?
I'm doing great. How are you?
Good. I love the Twitter handle. You know, I say to people, we're all captains of our own ship. And
right.
You're Captain John Charts. So, you know, John, I know that you're an RIA now and you have different services. It's always fascinating to me and our audience how people get from point A to point B and finding out what it was like for them in the early stages of their career in trading. Can you tell us a little bit about how you got started, who introduced you to it, if you had mentors, etc.?
Right. Well, everybody has a story, right?
Yeah.
I started out, I've been telling people it's 95, but it's actually 1994. And so that's long ago. But I can tell you, when we filled out our tax returns, your occupation was stockbroker, okay? So I got into business. I come from an engineering background. I decided, I fell in love with the market. And of course, I didn't know anything about the market, but I still.
Why do engineers? And you know, when I was a commodity broker, they were my best prospects. Why do engineers gravitate towards the markets? Could you answer that?
Well, I think I can. I think the reason is I've done quite a few presentations, and typically anybody that's mathematically inclined will look at the presentation and go, "Oh my God, I got it."
Okay.
And I'm not, not to be biased towards that group, but I think it's, when you start looking at technical analysis, I think a lot of the engineer types just gravitate toward it. It makes a lot of sense to them.
Okay.
Especially when you start going to things like Fibonacci and so forth and so on.
Okay.
But anyway, I didn't know, I really didn't know what I was doing, even though I went through trading and got all my licenses and everything. And I probably went through building my business, in the first year and a half, 2 years, mostly was selling muni bonds and mutual funds, and eventually people wanted to do individual equities. And once again, I really didn't know what I was doing, so I relied on the wirehouse research, which I'm sure this would be no surprise to you. It got me absolutely nowhere, and I got very frustrated to the point I was ready to leave the business. And the firm that I was working at the time was Dean Witter, which became Morgan Stanley. And my manager was kind enough to say, "Hey, listen, don't give up. There's this guy we're bringing back to the firm. He started technical analysis in the early 50s, and the guy is just, he's incredible." Well, that was my start. I started following this guy, and
who was it?
His name was Lou Smith.
Okay.
And Lou was great. No one really, it was amazing. He was probably the best resource in the firm, but nobody listened to him. None of the advisors listened to him. Really, they didn't know about him, or they didn't know what he was talking about. And he showed me the way. He was a big picture guy at the beginning, and then he would go through, into what's working in the market, sector rotation, and where the relative strict leaders were. And
He was your teacher, John. He was your mentor.
Absolutely. He was my mentor. And I love the guy because I could call down to Times Square and I'd get directly, he'd pick up the phone. All right. Because nobody else listened to him. So he talked to me in Portsmouth, New Hampshire. So we became friends, and I eventually did get to meet him and have lunch with him. But he introduced me to what's known as point and figure charting. And
oh, yes.
I had no idea. Yeah, I looked like a tic-tac-toe board. I had no idea what he was talking about. I had bought, I think at the time, one of the first stocks I bought was Intel, and it was around $50. And it just, I had called him, and he said, it looks great on a chart. And our fundamental analyst had a target of 60 in a matter of couple of months, it went up from 50 to 60, and I called him up and I said, hey, should I sell it? And I said, to hit the analyst target. And he said, I don't know what that analyst is smoking, but that thing's going to 90. I'm like, what? So I held on to it, and it did go to 90. And I said, geez, how did you know it was going to go to 90? And he explained to me what a vertical count was. And so that was my kickoff into charting. This was originally the point through the charts. And then I just ended up pretty much self-taught, learning about, candlestick charts and all sorts of other things. And,
yeah, a lot of floor guys, a lot of floor traders use point figures. They'd have their clerks plotting the X's and O's and give them signals when they'd have a change. So it's kind of a lost art.
It is. And when I went to my manager, I said, hey, you know what point, again, if it was 90, probably 96 at this time. You know what point figure charts are? He was like, oh my God, I haven't seen one of those in 25 years. So it's been around. I believe it has its roots in back to the days of Charles Dow. So yeah, it's been around a long time. And if there's one thing, if you did nothing else but at least learn that, I think you put yourself in the top 15% of money managers / investors.
Okay. So here we are now, Bill, and the markets have become a little bit more binary. So I'm very interested in taking a look at some of your technical work here. You have both a newsletter or signal service, plus you're a registered investment advisor. Is that your business model? You have two of them?
Exactly. We have both.
Okay. Okay.
And that's great because some people have a 401k, right? And they can't turn it over to be managed, so we provide a service for them as well. Or some people want to, make some decisions themselves, and the subscription service works out best for them.
Okay. I did notice on your RIA that you have discretion, power of attorney, so that you can make changes to allocation or sectors. Do most registered investment advisors have to call their client before they make any changes to their portfolio?
I would say, I don't know the number on registered investment advisors, but I would say in general, probably 99% don't have discretion. And I'll tell you, I'm glad you brought that up because this is a very important point. In order to do what I do and what others like me do, you need the ability to be able to act on the behalf as a fiduciary for your clients. And what does that mean? What that means is I don't have to pick up the phone, Dale, and call you, and you're in a meeting, and then you got to call me back, and then I got to call you back. And
then it's gone. Right?
It's gone.
Yeah.
Well, by the time I get in touch with you, it's probably time to get back in or get back out, right? And then and the other problem you have, which I was frustrated with, is that who do you call first? What if you have 100 clients? Do I call the biggest client first, the smallest? Do I call my best friend? Do I call, So it causes a lot of conflicts. When you have discretion and you're not doing it on a commission basis, you're doing it on a fee basis, you put yourself on the same side of the table as the client. So say, for example, we buy XYZ in a certain model, everybody gets that product, same percentage, at the same price, at the same time. And I was, pleasantly surprised that when I started doing discretion in 2003, that almost everybody wanted it. They didn't want to be really involved necessarily in the day-to-day, week-to-week communications and making decisions or approving decisions.
And then you have to go through explanations. Why are you doing this? And
right.
I remember being, when I would prospect for accounts, that perhaps I'd see a scenario that, was fairly imminent, and my prospect would say, well, you know what, I have to talk to my accountant, or I have to talk to my wife, and I would say, well, you know what, let me call the exchange and ask them to halt trading until you make a decision. And they would say, John, oh, no, Dale, you don't have to do that. They didn't want me to halt the markets for them. Anyway, so, we've had a lot of two-way action. Are you enjoying the fact that now indexes are more binary than a one-way street? And I'm curious as to what's on your radar in different instruments or indices.
Yeah, well, I mean, to answer your question, I mean, obviously it's a lot more fun when you have a one-way market, in the sense that it's easier to me, it's easier, at least for relative strength strategies. You know, first and foremost, I'm a buy high, sell higher, but there's times that doesn't work. We all know that. So here we are in a market that seems to be a little more range bound, something in it for everybody, right? The longs, the shorts. And for me, it's good for my business because it people become too complacent when things are going one way, and they know that they think they know, you know. It's the old saying, you know, confusing bull markets with a brain, right? So I do enjoy having a market that's a little tougher to navigate, and it's just better, quite frankly, for us to get new business. So
what are you seeing in here, John? You know, we had the initial break in February, a huge recovery, sell-off last week, and we're, you know, rallying to retest last week's highs. Well, not last week's highs, but recovery levels. So, okay.
Right.
This is your...
well, in some cases...
Okay, go ahead.
Some cases we could... I was just going to say, some cases we did take out the January highs, but probably for, you know, most of the major indices we haven't.
What, like Amazon has? Some of the FANGs have made new highs?
Right, Netflix, exactly.
Okay, yeah. Okay.
So, well, right now, you know, the way we were looking at things on a longer term, and I'll show you that in a chart here in a second, we really don't see any change in the big picture of the market. And the way we run our analysis is the first thing we want to do is we want to keep tabs on where the money's flowing. In other words, is the money going into U.S. stocks? Is the money going into international? Is it going into bonds? You know, is it going into commodity? And once we figured out where the relative strength is in the asset class, that's when we start digging down inside that asset class.
I love your maxims.
Thank you. Matt, I haven't heard that in a while, maxims.
Especially the one that's toughest for everyone. You don't always have to do something.
Oh, well, that brings me to another thing. And honestly, what was your guest prior to me? Was that Steve?
Steve Volge? Yeah.
Yeah. Well, he made me think of something. I had to add another chart to my presentation here. Can you see the chart right now? The presentation right now?
I'm seeing the break even and the loss.
Yeah.
Yeah.
Right. All right. So the one thing I didn't tell you is I played Division I football, and I know that doesn't make any sense being an engineer, but I did. And
let me ask you, where is Northeastern University? It's familiar to me.
Yeah, Boston, Mass. Downtown.
It's where?
In Boston, Massachusetts.
Oh, okay. Wow. Okay. What position did you play?
Inside linebacker.
Okay. You know, we have a team here, and you know what I've said? Like, you know, I was had a bad night and I was ill. Don't you agree that a good team always fills a hole? A good line always fills a hole, doesn't it?
Absolutely. And I would also say a great defense doesn't lose games.
Okay, great metaphor, Pearl.
So
yeah, I see your first maxim. That's what I was talking about. Never lose money. Don't forget. Never lose money. Buffett. Right.
Yeah.
But he does.
Well, you know, Steve got me thinking. You know, this is true. This happened multiple times over the years. And I run into somebody and they say, "Oh my God, you know, like, let's go back to the financial crisis, right?" And you would hear from somebody, "I cannot believe my portfolio went down 50%. My God, I'm going to have to go up. I'm going to have to go up 50% to get back to even." And I'm just looking at him and I'm going, "Wait a minute, you're a sharp guy." No, if you go down, I don't know if you can see my cursor here, but you need 100% to get back.
Yeah.
Right, exactly. And I said, well, what about we go back to the .com? I mean, there's plenty of stocks that blew up and on 90%, right? Well,
Yes.
if you go down 90%, you got to go up 900%. And people are just like, oh my God, really? So, you know, I look at things like, I don't consider myself a gambler, so I look at things from a standpoint of playing defense and trying to keep your losses at a minimum. So we're all going to have losses. That's part of the game. Is paramount, right? To your investment success, to the point that it's probably even more important than worrying about how you're going to get your alpha. So I wanted to throw that slide up because a lot of people don't realize. I love the one that's, you know, if you lose 90%, you got to go up 900%. That's ridiculous. So,
Okay, and even though you're trading equities and maybe ETFs,
right.
you don't trade mutual funds for your clients. What are the main instruments that you trade for your managed accounts?
For the managed accounts, it's stocks and ETFs.
Okay.
Primarily.
And your 3-to-1, you won't take a trade unless you have an RR of 3-to-1.
That's correct.
Okay, great rule.
That's correct.
And your chart.
I like to see 5-to-1, but you know, 3-to-1 is acceptable in most cases. So anyhow, with that said, let's getting back to managing, you know, losses. If I could share one thing with me, you know, a newer person, is a very simple thing you could have done. One thing you could have looked at over the past, 15, 20 years, that would have kept you out of getting your head chopped off in 2007, 2008, was to follow. This the chart I'm showing you right now, the S&P 500 going back to, I can't see my glasses, back to like 94. It's just a plain, simple moving average crossover system. And if you follow the
6 and 10 day?
It's a 6 and 10 month in this case.
10 month. Okay, they're monthly.
Yep. So it's long term. It's, you know, but just keep in mind, it's not. You may not be the one that's going to be sitting here waiting, you know, a couple of years to make a trade, but it's just to give you a big picture view of how you would have been helped. And I won't go through it all. You'll see little yellow highlights when different firms and different authorities told you to get into the market and told you not to be in the market. And obviously they were wrong every single time, so don't listen to the news. But if you'd gotten in when the green line crossed above the red line back in the early 94, 95 time frame, had one heck of a run. You didn't have to really do anything buying the major U.S. markets until it started to roll over in the first quarter of 2000 or so, and you see that the green line fell below.
Yeah, it got you out pretty good. It gets you out
pretty good, right?
Yeah.
Right. Didn't get you out the top, but it got you out enough that you didn't have to suffer a 35, 45, 55% lock, and then it puts you back in 2003, which was great because that's when I got my discretion. I was scared out of my mind starting out in the business when things were in a couple of year tailspin. But just watching this, I don't want to take up too much time on it. You can see that it took you out of the dot-com crash, put you back in, took you out before the financial crisis, put you back in, and the only problem if you want to pick on is over here on the right. You did get whipsawed a couple times, but it's not a really big deal. So getting back, we use moving averages, we use relative strength and of other tools to help guide us into gaining alpha, trying to have outperformance when we have a good market, and also to play defense. And I love what Steve said. Is cash is a position, right? I mean,
yep.
if you're RIA, if you're advisor, or you're doing it yourself, and you go, people say, well, geez, if I go into cash, I'm not going to make any money. Well, yeah, but if you're in a position where the best thing is cash, you better darn well be concerned with return of your equity or your money than your return on your money, right? So
Yeah,
that's
I've
how
heard
we're
that.
looking for it.
I like that one. Return of capital rather than return on.
Right on, brother.
Okay.
So we know going in for the past couple of years that the U.S. market's been the place to be. International market's been in second. And we can go down, into commodities and bonds and cash and currencies in terms of, exchange traded funds, sector funds, things of that nature. So the NASDAQ 100 really been a hot spot. And if you dig under the U.S. markets, under the S&P and the New York Stock Exchange, and this is just showing a relative strength chart, a price chart, and a relative strength chart here of NASDAQ versus the S&P 500. So what we like to do is go top down. So U.S. market first. Well, what's working in the U.S. market? Is it small caps, mid caps? Is it NASDAQ type stocks? Well, in this case, it continues to be NASDAQ type stocks.
I saw something interesting that I didn't know on CNBC yesterday, that European bourses indexes on average only have about 15% technology weighting compared to over 40% in the U.S., which could be a major explanation of the U.S. outperforming Europe.
That's interesting. I did not know that.
Yeah, I thought I'd share it with you. So they're very lightly weighted towards technology in the European markets.
Good to know. Thank you.
Yeah.
Well,
I thought it was more currency, or the economy wasn't as good, or problems in Europe, but it's actually part of it has to be, at least because of the performance of FANG and tech stocks, that they don't have as many companies in their indexes that are technology based.
Exactly. Well, you bring up a great point. Is back. I wish I held on to this report that I had. I don't know what happened to it, but back in, I think it was 98. The NASDAQ it might have been when long-term capital blew up, or it might have been, I can't remember. But anyway, there was a pullback in the NASDAQ about 30% plus, and the NASDAQ came right back. And the NASDAQ ended up being up like 38% for the year. But most people that had a portfolio that looked like NASDAQ were down for the year. And, you go, how the hell is that possible? How did you have this fantastic, 5-star fund that kind of mimics NASDAQ, and it's down, but yet the NASDAQ index up 38%. Well, what made it happen is if you took the look at inside the NASDAQ, it was 10 stocks that had it up 38%. If you took out 5 of those 10, it was like only up about say 7%. And if you took out the other 5, it went negative. So it was a very small piece, kind of like what you're seeing with FA.E.E and some other things right now.
Yeah, so we're seeing that type of concentration now, aren't we? Does that make you nervous?
I think so. Yeah. Yeah, it does, because, one of the things you watch is the advanced decline line. And the advanced decline line can be a great indicator for a precursor of what's to come. Often it will turn down ahead of the market indices turning down. And vice versa, it tends to turn up before the market turns up. So, and 80 lines is not in trouble right now, but it has been kind of flattening out, turning down a little bit, which is indicative of fewer and fewer participants. The old saying is, the generals, the soldiers have turned around and run the other way, and all that's left is the generals, and they're going to turn around and look and go, uh-oh, we're out here by ourselves, right?
When the troops retreat, the generals get slaughtered.
There you go.
Yeah.
I love that.
So are you seeing that now? Is that what this chart is? XLK?
No, this is just digging into NASDAQ, which you mentioned is heavily weighted in tech stocks. So here we go from NASDAQ. what's making NASDAQ work? Well, this is the XLK ETF versus the NASDAQ 100. Just another relative strength chart. You see it's going up left or right. That means technology is outperforming the NASDAQ 100 in general. And one of the things we did, we take it a step further. We go down to the chart analysis level. So we use line charts, we use bar charts, we use candlestick charts. We're very familiar with using different patterns. In this case, we had Microsoft a while ago as a core position, because one of the charts we love is a massive base, and I'm sure you know who Luisa Mata is, and yes. She had I think she coined the phrase, "The larger the base, the farther into space," something to that effect.
Yeah, that was.
We had this big. What's that?
That was my saying.
Was your thing? Beautiful.
Yeah.
I did not know that.
I have no.
She stole it from you.
Huh?
She stole it from you, Dale. She took it from you. Well, Microsoft had a monster base, right? 15 plus years. It finally broke out, and I did an update for us here. Let's see, come on. Oh, not too far. And you can see that on the very bottom, you see that gray line chart is showing Microsoft versus the NASDAQ 100. It began to break out in relative strength in early 16, and then we got the breakout on the multi-year base, I believe at the end of 2016. And so here we are, about 13 months, call it 14 months later, and we have Microsoft up, I believe, just over 60% from that entry.
Yeah.
So
yeah, because it went nowhere. It went nowhere from 2000.
Right. Yeah. Exactly. So it woke up. It came out of its hibernation.
Old tech, because people were calling it old tech.
Right.
Yeah.
Well, hey, a lot of us starting to wonder if we were ever going to see new highs out of some of these things in our lifetime. So we finally got it on Microsoft, and I granted, I mean, 60% return in 14 years may not be exciting.
I don't think we'll ever see split adjusted reverse splits that we had, and I don't think we'll ever see a new all-time high in Fannie Mae. What do you think?
Oh, well, how about Citigroup?
All right, so
I had somebody say to me, "Well, look at Citigroup's coming back. I mean, it was at 60 at its all-time high," and I'm like, "Yeah, but don't you remember that didn't it have like a 10-to-1 reversal or 15-to-1 stock split reversal? I go, it's still no.
Quite a few. Yeah, I think more than one.
I'll be 6 feet under when that thing gets back to 60.
Yeah,
that's for sure.
Yeah.
So that we're going to show just simply, how we work our way down from the big picture, down inside that, and then to the sector, and then to the individual equities. I threw a picture up here of Intel just to kind of show another one that broke out of a big base. In this case, a head and shoulder continuation pattern. And I just want to take a moment to talk about the model portfolio that we have, the X model, which is available to clients. We use Fidelity to custody our accounts in our RIA business through Capital Markets IQ, and that's also available for subscription services for folks. And in either case, I mean, we're at, on the advisory side, we're acting on there for clients is what we're sending out the signals on the subscription side. So we get you covered.
Okay, what's your minimum account size for RIA?
For the RIA, well, we prefer to have at least 50,000.
Okay.
Just makes it easier for us to move around. I mean, there's technically, I guess you could say there's no limit, but that's what works best for the size of the portfolios we run and the types of things that we buy.
Okay. And your subscription service, you have different levels?
Yeah, right now, well, we do have the flexibility to do customized portfolios. For one, I should mention that.
Okay.
And right now, the most popular is the X model, and we have a professional version, or also one that we use with other registered investment advisors. And we also, this just quick shows the timing model that we have in blue, and how we try to avoid drawdowns. And did I miss it? Oh, I did. I went too fast.
Yeah. Well,
this is a 20
massive performance.
Yes, massive outperformance. Drawdowns are minimal. That's the backbone to what we're trying to do here. And
What's your worst drawdown? What's your worst drawdown, John?
Worst drawdown, top to bottom, was 21%.
Okay, how do you manage yourself during a drawdown? Because I think that's where the rubber meets the road. Because that's when most people blow up. They increase leverage, they change methods, they revenge trade. How, now that you've been doing it this long, what kind of self-talk do you give yourself when you're going through a period like that?
Well, on the one hand, I tap myself on the back for not going down 60%, but we all know you can't eat relative strength, right? So that drawdown happened in 2008, and it was more from finding good risk reward setups that just got taken out and we got stopped out. And so it was, it was more of a death by 1,000 cuts.
Okay, so you use hard stops on your positions, or
correct,
end of day and then you get out. Hard stop?
Right.
Okay, because have you ever used mental stops?
Yes, both.
Okay, the last time I used a mental stop, my first stop was a mental institution.
Oh gosh.
All right, I had to set myself up for that. Okay, so all right, so here's your subscription service, right? The 48 and 98.
Right.
Okay.
98, more comprehensive, more one-on-one, availability for questions, more videos, etc. It's a tuned-up version of a $48 subscription.
Okay. Well, John, I want to hear one Nostra Butcofski. Where do you think the market's going to be in July? New highs? New highs, or okay, let's do this. Forget about the time. Are the lows that we had? Are the lows that we had at the 200 moving day average going to hold or be taken out?
I think they're going to hold.
Okay.
I think they're going to hold. I think if they don't hold per se in terms of I think there's a possibility to get pierced. Intraday, intra-week. I really, the only thing that concerns me, there's a couple of things that concern me longer term, but not enough to get, to start leaning more on the bearish side. But, our moving average systems are all still in a bullish configuration. And, you think about it in a long-term perspective, we have broken out. If you think of the major market and you look at the highs in 2000 and the highs in 2007, we've taken those out. So, I don't rule anything out. This could be the beginning of another big bull market. I'm not a super bull or super bear either way. But I think we're
okay. I once had a Skype conversation, and you were talking about gold shares. A view on the shares. I noticed yesterday when gold was down, the shares had a little bit of a heartbeat. Do you like the miners?
I do. I have not been following them as closely recently. I know that, and this was my analysis, so I do know that from a sentiment standpoint, that whole group is starting to look very good. Maybe you could chime in on that since I know you do a lot of that. I've heard that
All right, John.
commercials are pretty short, I guess, on the metals and, you know, so forth and so on. So I think there's a pretty set up sentiment-wise, and I know the charts on the stock market look pretty good too.
Okay, John. Thank you so much for your time today, sharing your journey and some great maxims and pearls. You're a natural teacher. So I wish you and your team and your clients continued success throughout the year, and it's a pleasure meeting you.
Hey,
So,
pleasure to you. I
thank you
appreciate you having me.
What's that, John?
I said I appreciate you having me on.
Okay, I had a great time with you and hope you enjoyed
well.
being here, and let's get back together down the road, okay?
I'd love to do that. Great.
Okay, everyone. And the best way to
Okay.
follow John is you could follow him on Twitter at Captain John Charts. And here's his information right here. You could email him. And the name of your website is CaptainJohnCharts.com. So
You got it.
check him out, you know, with retirement money, IRAs, he can take it all, and he's definitely going to be defensive for you. So again, good hunting, John, and I'll talk to you.
All right. Thank you, Dale. Take care.
You're very welcome. Thank you, F.A.C.E. See everyone tomorrow. Good hunting the rest of the day. And remember, most of all, don't just count your pips, count your blessings. We'll see everyone tomorrow for our Wednesday session. Adios.